Now we're going to talk about using ratios and formulas to analyze stock investments. So investors purchase stock to earn a return on their investment. The return consists of two parts. Hopefully, you buy the stock low and you sell higher to have a gain. It's called a capital gain. And a stock could pay a dividend. Remember, not all stocks pay dividends. So when deciding whether to buy a stock, you always have to consider the price of the stock. So that's the point where we're at now. We're going to include some ratios that look at the price of the stock. So no matter how profitable a company is, a stock can be a bad investment if you're paying too much per share. So 3 ratios will help analyze stocks as investments. They include the PE ratio, price to earnings, which is probably the most common ratio that investors use, the dividend yield, and book value, which is kind of an older formula that people don't use nearly as much anymore. The PE ratio, the price to earnings ratio, commonly known as the PE ratio, is the ratio of the market price of a share of common stock to the company's earnings per share. So the formula is the market price per share divided by earnings per share, also known as profit per share. This ratio is abbreviated PE and appears in the Wall Street Journal stock listings and all over the internet. So people are looking at PE ratios quite a bit to analyze whether a stock is a good price or not. So what it's showing is the market price for $1 of earnings, for $1 of the thing on the bottom of the formula. For example, if Microsoft's stock price is 22 and the earnings per share is 2, Microsoft has a PE ratio of 11. That means to earn $1 profit per year, the investor is paying $11. So is low or high considered better? Well, you want a low market price, so the number on top you want to be low, and the number on bottom you want to be big, so lower is better. But don't buy stock based on any single ratio, not even the PE ratio. Some stocks have a low PE ratio for a reason. And of all the ratios that people use to analyze stocks, PE is the most popular. So now let's talk about dividend yield. The formula for the dividend yield is you take the annual dividends per share and you divide it by the market price per share. Here's an example. A company is paying $1 dividend and it has $50 per share price. Well, so what's the dividend yield? It's a 2% dividend yield. So that means if you invest $100 into that stock, everything else being equal, you're going to get $2 of dividends or 2% return per year. Now, that doesn't include the price of the stock going up and down. That's just talking about the dividends. So this measures the percentage of a stock's price that is returned annually as dividends. So compare this dividend yield to a savings account yield, which is better. Well, oftentimes a stock's dividend yield is higher, but it depends on where interest rates are at. Which is riskier and which has a higher return potential? While stocks, remember, they can cut their dividend, they can eliminate their dividend. Of course, they can also raise their dividend. So stock dividends have a higher return potential than a savings account, but a savings account is usually FDIC insured, which means it's guaranteed by the federal government. So with a dividend yield, high is good, but if it's too high, it might be a sign that the dividend is not sustainable and may be reduced. So how would you like to invest in a company paying a 6.5% dividend yield? Does that sound too good to be true? Well, there are other ways to check to see if it is too good to be true. We're now going to talk about the dividend payout ratio. The formula for this is annual dividends per share divided by the earnings per share. So it's measuring the percentage of earnings paid annually to shareholders as dividends. So you have to be careful of a payout ratio that is too high. So here's an example. A company is paying $1 per year dividend, but their earnings per share are only 50 cents a dividend. So what's the payout ratio? 200% payout ratio. That means they're paying out twice as much as their profit. If a company has a dividend payout ratio of 200%, can it continue to pay out dividends that are twice its profits per share? No, it cannot continue to do that. Something has to change. It will have to cut or eliminate its dividend if its profits do not improve. So an example, in September of 2012, Illumina, ticker AWC, had a dividend yield of 6.5%, but had a payout ratio of 328%. I remember this because I was analyzing the company to see if it was a good investment. So in this case, something must change. Either the dividend must be cut or profits need to rise substantially. What happened was Illumina had to cease their dividend for 3 years.